Hey there, welcome back to. Today we're diving into a topic that many find fascinating and sometimes a bit confusing, the stock market. We're going to break down the basics, from understanding what the stock market is to the key players, stock exchanges, and how stocks are valued. We'll also touch on how to buy and sell stocks, stock indices, and the risks and rewards involved. So grab a pen and paper if you'd like to take some notes and get ready to dive into the world of stocks. So, what exactly is the stock market? Imagine a grand marketplace, but instead of fruits, vegetables, or clothes, it's brimming with shares of publicly listed companies. These shares essentially are tiny pieces of ownership in a company. When you buy a share, you're buying a piece of that company, becoming a part owner. This marketplace, where shares are bought and sold, is what we call the stock market. These shares represent ownership in a company, and the stock market is where they're bought and sold. Now, let's talk about the key players in the stock market. These are the people and entities who make the market tick. First, we have the bulls and the bears, terms that are often used to describe market sentiment. Bulls are optimistic participants who believe the market is on an upward trend, while bears have a more pessimistic outlook, expecting the market to decline. Next, we have investors and traders. Investors are in it for the long haul. They buy stocks with the belief that the value will increase over time. Traders, on the other hand, seek to take advantage of short-term price fluctuations. Lastly, we have market makers. These are usually large financial institutions that buy and sell large amounts of stocks. They play a vital role in maintaining liquidity in the market, ensuring that trading can take place smoothly and efficiently. These participants all play a crucial role in the buying and selling process. Stock exchanges are like the marketplaces where stocks are traded. They act as the backbone of the global economy, serving as hubs where investors can buy and sell shares of public companies. The most well-known exchanges include the New York Stock Exchange and NASDAQ. These platforms facilitate millions of transactions every day, connecting buyers and sellers from around the globe. They are essential for companies too, as they provide a venue for them to list their shares, making them available for public trading. The value of a stock is determined by supply and demand. Fascinating, isn't it? When more people want to buy a stock than sell it, the price goes up. This is because the increased demand and limited supply drive up the cost. On the other hand, if more people are looking to sell a stock than buy it, then the price goes down. This is due to the increased supply and limited demand. But that's not the whole story. There are also other influences at play here. The company's financial performance, for instance. If a company is performing well and making profits, its stock value could rise. Conversely, if it's doing poorly, the value could decrease. Then we have broader economic conditions, which can affect entire industries or sectors. Lastly, market sentiment, which is the overall attitude of investors towards a particular stock or the stock market as a whole, can sway stock prices. Factors like company performance, economic conditions, and market sentiment also play a role in stock valuations. And now let's talk about how you can buy and sell stocks. The process is relatively straightforward but crucial to understand. Investors don't usually engage in trading directly. Instead, they place orders through intermediaries known as brokers. These brokers serve as a bridge between you, the investor, and the stock exchange. Now, there are two main types of orders you can place. The first is a market order. This is an order to buy or sell a stock immediately at the best available current price. The second type is a limit order. With limit orders, you get to call the shots. You specify the price you're willing to buy or sell at. Limit orders allow investors to set a specific buying or selling price. Stock indices, like the S&P 500 or Dow Jones, are used to measure the overall performance of the stock market. These indices are essentially a collection of stocks representing diverse sectors of the economy. They serve as a reliable benchmark for the market's health and direction. When you hear that the market is up or down, it's often these indices that are being referred to. When the index goes up, it indicates that, on average, the prices of the underlying stocks are increasing. It's important to understand that investing in the stock market involves risks. Prices can fluctuate, sometimes drastically, and you may not always see the returns you hope for. But don't let that scare you away. Despite these uncertainties, historically, the stock market has provided solid returns over the long term. And there you have it, a simplified guide to how the stock market works. We've uncovered the key players, explored stock exchanges, understood how stocks are valued, and discussed the risks and rewards of investing. As you embark on your investing journey, remember, knowledge is power, so don't hesitate to dive deeper and continue learning. If you found this video helpful, do give it a thumbs up and subscribe for more enlightening content.